Welcome to The Explainer. Today, we're diving deep into a really powerful, but let's be honest, pretty complex 529 plan strategy. We're talking about a technical look at how you can move some serious wealth between family members completely tax-free, but only if you know the rules inside and out.
So let's just jump right in with a big question, right? Can you really move $1 million between sibling 529 plans and do it completely tax-free? Well, this isn't just some hypothetical puzzle. The answer is a solid yes, but it's buried deep in the tax code. And let me tell you, if you can master these rules, you're unlocking some massive financial planning opportunities.
Okay, so to really get this strategy, you first have to understand just how weird a 529 plan is from a legal standpoint. It's what we call a statutory anomaly. See, under IRC Section 529, the second you put money in, the IRS considers it a completed gift. That means it's out of your taxable estate. But, and this is the key, you, the account owner, still have complete control. You can change everything. It's kind of like giving a gift but keeping the remote control for it. This little paradox is what makes this whole strategy possible.
So how do you actually exercise that control? Well, it boils down to two core mechanics, the rollover versus the beneficiary change. And believe me, understanding the difference between these two actions is absolutely critical. Get them mixed up, and the whole thing falls apart.
And this right here is the key distinction you have to burn into your brain. A beneficiary change, that's just an internal swap. You're staying within the same 529 plan, you're just changing the name of the person who gets the money. You can do that all day long, no limits. But a rollover, that's a whole different beast. That's an external move. You're taking the money out of one plan and putting it into another. And that action, that's the one that has a very specific and very important rule attached to it.
And that key constraint is what we call the 12-month rule. You can find it right there in IRC Section 529 C3 C3II. And it's simple, but it's strict. You can only make one tax-free rollover for the same beneficiary within any 12-month period. That's it, one per year. Now, this rule can bring your whole strategy to a screeching halt unless you know about the powerful exception.
And here it is. This is the absolute core of the sibling strategy. Remember that 12-month clock we just talked about? The one that says you can only do one rollover a year? Well, that clock doesn't apply if the rollover is to an account for a new beneficiary, as long as that new person is a member of the family of the old one. So by changing the beneficiary to, say, a sibling, you effectively reset the clock. It's the move that lets you sidestep the one-a-year limit.
So, you're probably wondering, who exactly counts as a member of the family? Well, the IRS definition, right there in IRC Section 529E2, is surprisingly broad. We're not just talking about your kids and spouse. It's siblings, parents, aunts, uncles, nieces, nephews. It even includes in-laws and first cousins. This gives you a ton of flexibility when you're planning these moves.
Okay, so we've got the mechanics down. But now we're moving into what is, without a doubt, the biggest trap in this whole strategy, the federal gift tax. This is where things get really counterintuitive, and it's where a lot of people, even smart planners, can make a huge mistake.
And you don't have to take my word for it. The law itself, right, in Section 529C5B, basically puts up a big warning sign. It says, hey, gift tax and the generation skipping transfer tax, the GSTT, they will apply to these changes unless the new beneficiary is in the same generation as the old one, or maybe even a generation higher.
So what this does is create a really clear line in the sand. On one side, you've got the safe harbor. That's when you move money sideways, generationally speaking. Brother to sister, cousin to cousin. Do that and there's zero gift tax consequence. I don't care if it's $1 million, it's a non-event. But the second you cross that line and move the money down a generation, say from an aunt to her niece, bam, you've just triggered a taxable gift.
Now here comes the most critical, most mind-bending part of this whole thing. If a gift is triggered, who's the one making the gift? Logically, you'd think it's the account owner, right? The person calling the shots? Wrong. The IRS says the gift is made by the old beneficiary. They are the deemed donor. Let that sink in. A parent owns the account. They change the beneficiary from their child, let's call him Alex, to their grandchild, Alex's daughter. Who just made a taxable gift? Alex did. He just made a massive gift to his own daughter without ever touching the money. It's a huge twist.
Okay, so that sounds pretty scary, right? Your kid just accidentally made a huge taxable gift. But fortunately, there's a powerful tool they can use. The old beneficiary, our new deemed donor, can use the famous 5-year Superfunding Election. The proposed regs, specifically Section 1.529-5B3, confirm this. It basically lets them take that one giant gift and tell the IRS, hey, I'm going to treat this as if I made it in 5 equal chunks over 5 years.
This lets them use 5 years' worth of their annual gift tax exclusion all at once, which can often wipe out the taxable gift completely. All right, but we're not done with taxes yet. On top of the gift tax, you have to layer on a whole separate and frankly pretty punishing tax, the Generation Skipping Transfer Tax, or GSTT. This thing is a flat 40% tax that kicks in when you move money 2 or more generations down the line.
This tax gets triggered when you make a transfer to what the code, that's IRC Section 2613, calls a skip person. And for our purposes, a skip person is just someone who is 2 or more generations below the transferor. And who's the transferor in our 529 scenario? You got it. It's the old beneficiary.
So, how does the IRS count generations? Well, IRC Section 2651 lays it all out. A sibling-to-sibling transfer, that's same generation, no problem. But look at the last example. An aunt changes the beneficiary to our grandniece. Let's trace that. The aunt is 1 generation above her niece, and the grandniece is 1 generation below the niece. That's a 2-generation jump. That makes the grandniece a skip person relative to the aunt, and that move could trigger the GSTT.
Now, hearing a 40% tax probably makes your heart skip a beat. But hold on, there's a massive shield here. Every single person gets a lifetime GSTT exemption. By 2026, that number is projected to be somewhere around $15 million. So what happens in reality? Our old beneficiary, the one who made the transfer, just files a gift tax return and allocates a piece of their giant exemption to cover the transfer. And just like that, the 40% tax goes away.
Okay, so you've perfectly navigated the federal gift tax, you've handled the GSTT, you think you're in the clear. But wait, you could still get hit with a surprise tax bill, and this time it's coming from your state. This is a huge trap that a lot of people fall into.
The issue is something called recapture. It works like this. A bunch of states, to encourage you to save, give you a nice state income tax deduction when you contribute to their 529 plan. But there's a catch. If you then take that money and roll it over to a plan in another state, they say, whoa, hold on, we're taking that tax break back. And they do it by adding all those deductions you took over the years right back into your income for the current year. Ouch.
And this isn't just a theoretical problem. Look at states like New York, Illinois, or Virginia. They have very strict recapture rules. So let's say you're in New York and you do a perfectly legal, federally tax-free rollover to your other child's 529 plan in, say, Utah. Well, you just triggered a New York state tax bill. So what's the workaround? The simplest solution is often to just avoid the out-of-state rollover. Instead, just change the beneficiary on the existing New York plan. You get the same result without triggering recapture.
Okay, let's bring it home with the final, crucial piece, compliance and reporting. Because look, you can have the most brilliant strategy in the world, but if the paperwork isn't filed correctly, it all means nothing. This is about making sure your moves are documented and can stand up to any IRS scrutiny.
First up, the Form 1099-Q. Anytime you do a rollover or take a distribution, one of these forms is going to get generated. Now, don't panic. This isn't a tax bill. Think of it as the IRS's receipt for the transaction. It's your job to hang on to this form because it's your proof that what you did was a tax-free rollover, not a taxable withdrawal. But the really critical piece of paper is Form 709, the U.S. gift tax return. You've got to file this in 2 specific situations. First, if you do that 5-year Superfunding Election when you first contribute, that's a must. But second, and this is the one everyone forgets, the old beneficiary has to file one if the beneficiary gets changed to someone in a lower generation and the amount is big enough. That filing requirement falls on them, not the account owner. So what happens if our deemed donor, the old beneficiary, is, a minor? A 10-year-old isn't exactly going to file their own gift tax return. In that case, the responsibility falls to their parent or legal guardian. They are the ones who have to sign and file that Form 709 on the child's behalf. It's a critical fiduciary duty, and you absolutely cannot let it slip through the cracks.
So when you pull it all together, what does it mean? The 529 code gives you this incredible, flexible tool for moving wealth. But its real power comes from precision. You have to get it exactly right. The question you have to ask yourself is your strategy truly compliant? Or have you accidentally stumbled into that deemed gift trap, creating a surprise tax headache for your kid down the road? Getting this right is the difference between a brilliant financial move and a costly mistake.